On today's episode of the AI Investor Podcast from 24/7 Wall Street, we sort through the market wreckage and discuss which stocks are the ones to buy today, if you're brave enough. All of that is next. Welcome back to the show. I am David Hanson, joined by Eric Bleeker. Eric, anything going on recently? Market, just a quiet place? How are you?
You know, I know we do this every 2 weeks where it's like, oh, everything happened. And this felt like 7 years in the market. If you're new to investing and wondering if this is what it normally feels like, this is not normal. This is as far from normal as it can get. And, hopefully today we'll be able to kind of sort through the wreckage as kind of give everyone a perspective on, where we're going from here today.
Great. Yeah. Well, if you happen to be living under a rock and have not been paying attention to the market, I would probably categorize the last 2 weeks as certainly the most wild in about 5 years. I think going back to the downturn in COVID was obviously similar in terms of volatility, having huge down days and then having a few big up days. Obviously, we had a huge up day on Wednesday. I think the NASDAQ was up 12%. And then yesterday, Thursday, we're recording this on a Friday, fell about 5 to 6%. So giving about half of that back. So incredibly volatile, to your point, very atypical. You only see these during kind of crises. So I don't know if we're ready to, I don't know if you're ready to call this a crisis or really what's going on in the market. So I do want to just get your take on how you're thinking about the portfolio, how you're thinking about your own investments. And more specifically, obviously tariffs are the number one thing on every single news channel. It's probably the number one thing on like Nickelodeon. Everyone is talking about tariffs right now. So people listening to this podcast, they're probably wondering, we get it. It's obviously a disruption to the market, but how is it impacting the companies in the AI space specifically? We've talked a lot about companies that are domiciled in other countries, in Europe, in Asia. Are they impacted by these tariffs? So kind of just where are you market-wise? And then let's get into potential impact. I'm going to key in on that word potential because we just don't know exactly where all tariffs will land, potential impact on some of the companies in this space and in our portfolio.
Yeah, David. So you've asked me the question in recent episodes, what percent of kind of price action in the semiconductor space is due to macro factors and the risk of recession, and what percent is due to kind of activity and news in the AI space? The reality is right now, we are pretty close to 99% of all price action being driven by macro factors. When we started this podcast, which was in the summer of last year, we had said the valuation, the PE multiple for the S&P 500 heading into 2025 was high, but was predicated on the idea of strong earnings growth. So we were coming in at, a PE in the high 20s, but it was expected to be 13% growth in 2025, which is a very strong multiple. What's happened right now is growth is essentially being zeroed out. So if you're looking at the market and saying, what is the primary factor in the market going down? Well, the primary factor is that there's incredible amount of money, both in consumer spending and also investment on the business side. And EPS estimates for this year for the market, they range from flat to a lot of people seeing how far below last year they could go. It makes a lot of sense why a market will fall in that environment. Let's put the specific AI portfolio in context. The beginning of the AI boom, you can really track it back to a couple dates. Number one, November 30th, 2022. That's the date that ChatGPT was announced. Now, the impacts of AI have a very specific date, and that was May 24th, 2023. That's the first date that NVIDIA announced earnings and it became clear how much growth there was potentially in semiconductors. David, here's what's incredible. Since that date, the main semiconductor index, the SOX, is now flat.
Wow.
So we've seen this incredible growth in the boom of AI. We've seen semiconductors as an industry growing 21% last year, still growing 17% in February in spite of everything. And we've seen absolutely zero investing returns. So when people are talking about how hard investing is, this is why investing is so hard. We've maybe seen the greatest trend in technology history. And so far, if you've been investing in the one area that's seen the most attributable revenue growth, you have seen zero returns in 2 years. So that's the fine point to put on this today, right? We looked before we came on, the AI portfolio, it's down about 24%. I expect it to be more. I mean, and that's not to give ourselves an excuse. We've made mistakes, and, I'll talk about some later because I'm going to talk about some personal investments I've been making during this. But, these are a lot of stocks that are, at this point, they're not trading on any fundamentals for what the stock's doing. They're essentially trading just as macroeconomic levered plays. If you're an optics stock, we see when the tariff stuff's happening, they're going to be down 2 or 3 times as much as the market. When Trump announced that 90-day pause, they were up 25% in a day. Right. A lot of them. That's just what we're doing. They are levered plays on the economy. So I don't know, David. I've said many times, we are not a political show. If you want to go and get arguments about people who think Trump's a genius or think he's the worst, there's 100 podcasts that do that. 1,000, probably 10,000. We are not that. But at this very moment, I think we do need to talk about the situation as well. And neither of us are macroeconomic experts. There's about to be a lot of people who are macro experts on Twitter, a lot of people who are going to be bond experts. But we have been in the market. And David, I think it probably is worth just deconstructing to a little bit what's going on at a very high level. So, David, I would just start by kind of asking you too, as an investor, how do you feel looking at this environment and, your appetite to invest from this point today?
It's uncomfortable. I think a lesson that can be learned from prior times of huge, downside volatility, and there's kind of an immediate jump to want to say, I'll wait until the dust settles. And it doesn't feel great while there's so much commotion going on. But if you look back at past times like this, you cannot wait for the dust to completely settle. The market will move before you. So you have to know that and be comfortable that even if you go back to COVID, if you think back to in those early 2020s, I think we bounced really hard off of the lows and into April and May. And there was kind of this feeling of like, this can't be true. Things are still so bad. Everything's still so locked down. This has to be a head fake. The market was seeing through it, and the market was right in that we got through it. And if you were waiting for, COVID to be all clear, you would have missed an incredible opportunity to continue investing. So that's just one example of, I know that I'm not going to be able to call the exact bottom, but I also know that I cannot wait for all uncertainty and all of the dust to settle. That if there are companies that I like, and if I have cash available, you have to kind of get over that hurdle. And I'm continuing to try to just invest continuously and put money in, knowing that I'm not going to get the bottom exactly right, and knowing that I cannot wait for the dust to settle. So that's kind of where my mindset is at. That doesn't make it any easier to see, positions down 30% in the blink of an eye. But that's my kind of leaning on history of how the market operates. And I'm pretty confident that's how it's going to happen right now, in terms of you're not going to be able to know this is the bottom.
Yeah. And, I think you raise a great point in that COVID era, because you and I were going on almost daily, webinars at the Motley Fool to talk about that. And we talked a lot about the concept of a V recovery. And that did turn out to be correct, as you noted. A lot of people, there's this fantasy that people have about buying the dip. As you noted, it's easy to say it. It's almost impossible to do at the bottom, number one. Number two, COVID's an excellent example, because if you had sold out as we were into that kind of crash head into COVID, which plenty of people do, there's a reason stocks decline. It's because people are selling, right?
Right.
And if you sold and you started seeing that recovery, which was recovering before there's any good news, and you were saying that's a dead cat bounce, it still has further to go, you would have kept holding as it fully recovered. You probably would have kept holding into the summer as news got worse around COVID. And, you probably would have capitulated at the beginning of 2021. And what do we have since the beginning of 2021? We have largely a flat market. If you go back to November of that year, and you look at S&P returns, we're basically flat now, right?
Yeah.
So, that's we've talked in the show about the idea of, would it be good to do market hedges? I said, it's very easy to look at the times that you are right about things and say, oh, I should have had a market hedge. But there's a lot of times that you are hedged when you don't need to be, and those costs really add up. So we've mostly focused on the good ideas here. But, David, if we are looking at this specific environment, what's going on is that it is largely self-inflicted, that we had a pretty good environment. Expectations in January did remain at that 13% earnings rate. They've largely dissolved from specific actions from the Trump administration. But we also look at how quickly things can reverse. What happened this week with the pause on tariffs? I know that Trump wants to come out and say it was my plan all along. That's just not true. Like you can see this. What basically happened that you can have at a pretty good confidence level is headed into Wednesday. 10-year rates were soaring, and as we've talked about in this podcast, the Trump administration has really put an emphasis on 10-year rates because they believe if they can get it down, you can get our interest borrowing cost down, which is becoming a major issue. There's $10 trillion in borrowing rolling over in the next year. They also want to unlock things like housing and lending. Trump used to work in real estate. He understands how lending costs freeze things up. The problem is, we had these 10-year kind of surge on Wednesday. They removed the tariffs. We saw a 12% bounce in one day. The ongoing problem that we're facing, David, is really a matter of context. It's a $27 trillion economy. We've got $3 trillion in imports, $2 trillion in exports, and everything's focused around that right now. The problem is we're dealing with much bigger numbers that kind of swamp these. You look at the kind of capital outflows that happen from these actions. You look at the potential loss of tax receipts from recessions, and it just kind of swamps the potential good from getting, concessions in these trade negotiations. So I think the market's really calling out for wanting to move beyond a focus on tariffs. And the problem is you just don't know when that moment could happen, because in the background, what we probably saw happen was there's two wings in this White House. There's trade hawks like Peter Navarro and Howard Lutnick, and there's people that prefer a more balanced strategy like Scott Bessent. It looks like Bessent won for now. What Bessent would like to do, if you go and listen to interviews, he says, we do need to rebalance our economy, but that's a matter of not just tariffs, it's a matter of tariffs and regulations and a number of factors. And he sees tariffs as just one tool. Mm-hmm. If that becomes kind of the focus of the administration, we could quickly see a very strong rebound, right? So it's just, it feels like we are standing on the boundary of some systemic issues. If all of a sudden you see the reserve currency stats of the U.S. getting tenuous, if you see these 10-year rates start to rise, it feels like something's spiking out of control. But we are just a couple policy decisions from, as you mentioned, probably seeing a very steep rally. So, this is a long way of summarizing what's going on to say, when you are down 25%, as the NASDAQ, I think, has been, it is going to feel extremely painful, but there's probably more in the next 2 years from these price levels that can go right than wrong. And that doesn't mean that you necessarily want to just put all your money in at this moment. But how I'm thinking of investing from this moment is I look at the cash I have available to move into the market, and I'm just trying to do it over a phased area. Some points I'm going to move some money in and it's going to be down more. And some points, you might be kind of very much at this bottom, but typically at price levels that have moved this fast, if you can take a horizon that's multiple years, your probability of moving money, barring an event like the Great Depression is close to 100%. So I think people need to keep that historical context in mind, because if you are waiting for things to be comfortable, you are not going to be able to invest in this period, because the second that you'll see some activity like Trump shifting away from tariffs, and all of a sudden the market reacting to that by surging higher, and by the time it feels comfortable, this moment's going to have passed, David.
When you think about AI stocks and companies and so many in the portfolio, does it give you do you feel more confident about that sector of the market? I know there was headlines when they came out with all of the countries, and you saw, Taiwan on there, and I can't remember the exact rate, call it 30 to 50%. And you immediately go, oh my gosh, like that, what happens to Taiwan? And then in the it's like, oh, semiconductors are excluded from the tariff. So does it give you more confidence that this is an area of the market that you had a few months ago? I think JD Vance was giving a speech that was kind of like, we got to win in AI. So It does seem like there's parts of the administration, it seems like almost consensus across the aisle in Washington, that everyone's kind of like, America needs to lead on AI. Does it give you confidence that even if there are some trade wars, that AI is going to get some special treatment here, and that there's going to be carve outs for technology that we think we should lead in, and that it's important not to hamper those industries?
Yes. So I have some specific numbers I want to share on that. In an environment like this, it's shoot first, ask questions later. So everyone's going to panic. Again, these are levered plays. Depending on the stocks you're looking at, the portfolio, they are going to see far in excess of general declines. That will remain true, even sharing some of these numbers I'm going to share. But if you look at tariffs as they are currently constructed, and keep in mind this can all change by the time we publish this video, let alone 2 weeks later. Semi-analysis, which I'll give a shout out to them. They do great research. I'm going to summarize a lot of the information that they've shared. They crunched the numbers and found that the total cost of ownership for the GPU cloud operators, the people actually spending the money from tariffs, is less than 2%. So in terms of actual tariff impacts, this industry is one of the least impacted industries. And let me provide some context to why that is. Essentially, as you can imagine, for tariffs that are announced and from all reporting hadn't been decided until hours before, and levied tariffs on islands populated entirely by penguins, and also islands housing U.S. military bases, there are going to be loopholes in them the size of Swiss cheese. And one of the ideas of these tariffs, or important concepts, is the reciprocal tariffs did not target every single country. Countries including Canada and Mexico, which are two of our largest trading partners, are exempted. So while there's no tariffs on semiconductors, as you noted, the definition for semiconductors is integrated circuits and dies. A lot of parts of semiconductors don't meet that classification, including GPUs and the racks that are actually sold. But here's what's important. A lot of production for the assembly of these racks has moved to Mexico. In fact, about 2/3 of it. So you have had an incredible shift in this specific supply chain to Mexico, a place that's not part of these reciprocal tariffs. So what is the most impacted part of our portfolio by tariffs? Optical modules. I'll talk more about those in a minute, but you're looking at 25 to 40% tariff rate. I have a specific way I think is the best way to play this from this moment. Equipment, semiconductor equipment, companies like Lam Research, which we'll talk about in a minute, they are not exempted by this. Now, here's the perverse thing. What Trump wants, or his stated goal, is to move manufacturing back to America. What you need to build semiconductor manufacturing in America. The equipment, which now is as uncompetitive in America as ever, so you can do with that information what you will. Now, let's break down a few of our specific categories we've invested in. If you're looking at the companies that supply data centers, so Vertiv, Schneider Electric, these are companies that have seen Vertiv specifically seen some of the biggest declines. There's a couple reasons for that. Partially, some of the liquid cool racks, there's been some delays in when revenue might start coming for them, but it's largely been the the risk of recession really punishing this company. These companies, Schneider has about 83% of its total costs domiciled in either the US, Canada, or Mexico. For Vertiv, that's 75%, 55% from the US, 20% from basically Mexico, and then the remainder from outside areas. So they actually have very little tariff exposure. Modules, which I said I'll describe a little bit more on, this is the riskiest part of the portfolio. We did a whole episode on them last week. Terrible timing. Because
hey, we did warn that they were risky.
We had an expert on to talk about, how they look given the declines. They've declined more since then. But this is the number one part of the portfolio that is levered to the economy and risk of a recession. It's always been an industry that it gets hammered in recessions because basically their margin profile degrades. They are in an extreme double whammy right now of recession risk and also worse tariff impacts. Now, I said I had a play within this area. I think if you were looking at this area, you listened to the podcast last week and you said, okay, optics, I get it's risky, but I am willing to take on some risk for the potential of return. Fabrinet, the optical module space has such high tariffs because of high exposure to China. Fabrinet has 100% of its production in Thailand. If a trade deal were struck with Thailand, this would be one of the most advantaged companies in the world. It was trading as low as $150 per share, bringing it down into low teens multiples. It's probably the least cyclical of these companies. I have personally added Fabrinet shares within the past week. I'll describe that more later. Finally, the semiconductor equipment area. This is a space, like I said, in the portfolio, we've got Lam Research, we've got Camtech. I think we've limited our exposure because of some geopolitical fears. The exposure for here is going to be Japan, Singapore, Netherlands, South Korea, but less China, which is a good thing. So the last area I need to talk about, and this is a portfolio mistake that we've made, David. I'm going to need to do like a million mea culpas for this. But after DeepSeek, we had said, okay, we get like, if there's really increased volatility, we had no idea what would be coming. But if there's increased volatility, let's get some of these, let's get a couple of hyperscalers, because generally we had assumed the main threat would be if they cut spending, it's a benefit to them, well, a negative to the rest of the portfolio. So we thought that this would be a way for people who are investing in the space to retain upside, well, maybe having some countervailing movements. The problem's been the Magnificent Seven right now. If there is a protracted trade war, Europe is already starting about wanting to target the US's largest tech companies as their main move. So that's another space of the portfolio with very specific trade impacts today. So David, I know that's a lot to take in, but I want to be very specific about the tariff impacts for the portfolio. As you'll see, if you're thinking, man, this portfolio has really got hit hard, and it's probably because of all the supply chain issues from China. It's actually not. It's largely because, once again, it's 99% just leverage to economic cycles right now, which makes it hard to invest, because you want to invest about which companies have the best future, who's got the highest growth rates, and right now that's frankly a little bit all out the window.
So would a quick summary kind of be the AI and semiconductor space? You don't see it as necessarily overexposed to the tariffs compared to, let's just say, the rest of the economy. Maybe about even, and in some cases, like, oh, it's actually maybe a little bit less levered to it. And it's really more of a, hey, recession fears have grabbed the wheel. And if we just have an overall decrease across the board on CapEx, not just in the AI space, but just corporate America spending less, that's really what's driving these companies down, less so the tariffs as kind of a percentage. Is that a quick way to summarize it?
100%. Yep.
Okay. Let's
better than me. Why didn't you just say it first, David?
So, I'm sure I don't think the tariff story is going to go away in the next 2 weeks, but you never know. I wanted to get into some actual news about, you talked about recession fears and tariffs. Those are grabbing all the headlines. If we didn't have those and you just looked at some of the news coming out of people actually building AI applications and companies in the space, you might think things are actually pretty good. So I wanted to just go through these real quick. This week we had Google CEO came out and said, yeah, like the guidance we gave on CapEx and AI spend is we're sticking to it. And I think his quote was, the opportunity with the AI is as big as it gets. So he doesn't seem to be hedging his bets and taking this out that the market has given him to, hey, you can maybe take it down a notch and don't be so aggressive. So just any other thoughts from that you took away from Google saying full speed ahead?
Yeah, I mean, so it's Google reaffirming its guidance, which was a big one because, as you know, they're at 75 billion. The other company that stopped short of reaffirming guidance, but had very positive things to say about AI was Amazon CEO Andy Jassy, who said AI is a once in a lifetime reinvention. It's seeing demand unlike anything they've ever seen. He said the main problem is chip costs, which he specifically targeted NVIDIA and used as an ability to talk up the chips that they are building from first principles for themselves, which is incredibly bullish for Marvell. And we've looked at Marvell. It's a company that's gone from 120 down to 50, in part because their guidance for the first quarter was slightly above expectations. What I had said at the time was Marvell wasn't as high because maybe the build wasn't as steep for a specific Trainium chip. But they actually have had announcements that they would be doing. There's some concern that they had lost the next Trainium chip, and they're actually going to be doing part of it because it's been broke up into a Trainium and a Trainium Ultra. And they've diversified to not just creating the what you call AI accelerators, but a whole suite of chips across Amazon's data center. So they actually, in many ways, Marvell's in a better position 3 months ago than it was today than it was 3 or 4 months ago. But their stock's down 60%. So, we see this situation a lot. And it's just, as we've said before, in the long run, your earnings and sales are going to basically drive share price. In the short term, it's largely sentiment. It's a classic example that I think, the stock to watch. I'll be really interested headed into earnings season. You're going to have companies left and right pulling guidance because of all this uncertainty. I'll be really curious what Meta says. Meta's been a company that's been kind of hammered beyond the market. Generally, they're in that leverage point. On a good day, they're going to rise more. On a bad day, they're going to fall because advertising's a cyclical industry. So, they are seeing some punishment. I'll be curious if they're the one that 60 to 65 billion this year, what their comments are. If they maintain, that's incredibly bullish. Microsoft, David, I'm not going to go on another rant. I would like to. I had people sending me texts this week. Oh, you see this Microsoft news of them pulling back? This is the same news we've talked about in 5 different podcasts here. We all know Microsoft had cut some leases. They are having to revise their plans because they've basically had a breakup with OpenAI. So this is old news. It's largely recycled by people with an agenda. But, we will be watching Microsoft's commentary head into earnings season. David, here's the big picture. So I mentioned earlier that semiconductors, the SOX index has seen 0% returns since NVIDIA basically kicked off this AI boom. We had 10% growth in data center CapEx in 2023. The boom kicked off mid-2023. 67% growth in 2024. 48% is still estimated this year. And next year, estimates still stand at 19%. And we've had 0% returns in that period. So, that shows the environment we're in. If we hit 19% next year and the general economic picture is rosy, I can give you a very confident guess of what the returns look like on all of these stocks. It is just a question of how quickly we move through this uncertainty and how quickly earnings estimates for 2026 start getting back on the previous track we expected. So
yeah, I also will be interested to hear Meta and Mark Zuckerberg's commentary. Obviously, my gut would be that he's still going to be aggressive. It seems like we're dealing with a new Zuckerberg. Obviously, he pulled back substantially in 2022 when the market kind of forced his hand and really said like, hey, you need to pull back on spend. You need to cut heads. They do have a new CFO that stepped in November 2022. So that's kind of at the bottom of, so maybe he doesn't have the same person in his ear of, hey, pull back. And, we're dealing with cool Zuckerberg now. So my bet would be that he marches forward. He's not going to fall behind in this race. But we'll see.
Totally minor thing too. Like if especially as we're getting towards a lot more capabilities of agents in the back half of the year, if you're a company like Facebook and you have a economic reason to do some, big layoffs again, like who are the companies most capable of beginning to replace those functions with agents? And in a way, some of these headwinds could be a pretty big accelerant for the beginning of some of these new AI trends. Don't forget that factor in all this.
So a few other just pieces of news just wanted to hit on real quickly.
Sure.
Google models, I think, on this show back in the summer, I think you cited Google as a company that's maybe falling behind on the AI front. You weren't the only one with that opinion. A lot of people were giving them a hard time on how did you miss this wave? You're really behind. Google's models now, kind of depending on how you're scoring them, near the top of the list. Obviously, in the race to get consumer applications in the AI space, you still have OpenAI. It seems like they are still the far and away leader in terms of usage right now. Many companies trying to catch them, including Google. So just one, are you as impressed with Google's models? Do you think that they can continue to bridge this gap? Or, you see other people say, the race is over, OpenAI is won, you can't catch them at this point. So where do you stand on kind of Google's ability to catch up in that space?
Yeah, you're right. I've done, if not a 180 on Google, a 179. Like I flipped quite a bit. They are shipping furiously. From a technical standpoint, what Google's doing is incredibly impressive right now. It's the Gemini 2.5. There's benchmarks that you can look at. They're in the lead. Then there's just vibes. And it's what people are saying in the space, what other users are saying, and it's generally regarded as the best model. So they've got the best model, which there's going to be a lot of leapfrogging there. But then they also have great models that they released recently and other, services that they've shipped for things like video, agents, vibe coding. They're shipping everywhere. So Google's doing an incredible job. David, here's the one description of Google that's going to summarize it. They're going to be Microsoft one way or the other. They're either going to be Ballmer Microsoft, where they just cling on to search as their analog to Windows and they don't do a good job adjusting and it's bad returns, or they're going to be Nadella Google and they're going to fully embrace this change. Google has incredible advantages. They have, with AI, they have a cloud computing division, or they can move, a lot of this stuff internally. If AI plays out like I think is, where you're going to have a consumer side that's a little bit more of winner take all, and you're going to have an enterprise side that, you're going to have companies dropping out of this race as it gets horrendously expensive and a few major players. Google has every reason in the world to be one of these major players. So I've talked about the sum of parts valuation on them. As they keep dropping, the valuation of search gets closer and closer to zero. So even if that's a negative sentiment in the market, they should have a very good chance over a number of years to fully shift their business to embrace AI if they execute. So spoiler for later when we talk about some stocks I bought, I've been adding Google relatively aggressively. So I love their position right now. I think they're going to be able to, with some short-term pain, they're going to get that better version of Microsoft instead of what they're priced for right now, which is the Ballmer version of Microsoft.
Yeah, I agree with you. The vibes, even from you think about, I think there's been so much talk over the past year or so of, is 10 blue links dead? And is search as we know it, is that not worth as much it is? And I think there's assumption that it's a little bit binary of search is very profitable, but it's going to go away. I think it discounts the fact that there can be innovations on how AI is integrated in search and how that's monetized. I don't think either of us can sit here today and know exactly how AI-based searches are going to be monetized in 5 years and the ability to find ways to integrate ads. So if you're a Google bull, I think you have to have some leap of faith of like, they're going to figure it out. Even if the interface of search changes, there's enough incentive to find ways and continue trying to matching advertisers with consumers, regardless of what the interface looks like, 10 blue links or otherwise. So a couple more things real quick. Broadcom, not the biggest thing in the world, but they didn't announce a new authorization of buyback of the stock. Maybe gives you a little bit of confidence if you're holding the stock. But hey, the company likes it; they're going to buy it. So anything to note other than just the fact that it's a vote of confidence from the company trying to give some assurance that they feel good about it.
Yeah, I think one of the biggest reasons to buy Broadcom is the CEO is a legend. I mean, he's a legend. I talked about him kind of holding some, he basically held some revisions to their total addressable market for a conference call he knew would be a low, otherwise disappointing to Wall Street. It took off. This guy's just smart. He knows how to play the game. That's just another example. There's a reason we made Broadcom the largest holding in the portfolio, and that's because, hey, like I was talking about earlier, should Marvell be down 60% when their fortunes got a little better? Well, but Marvell's been historically a poor performing stock. Broadcom's just a winner. It's just a winner. And they're going to find ways to make the best advantage of a situation. And seeing a buyback announced right now when everyone else is panicking is just another example of why, you ride with the best leaders because they're going to give you the best chance to win. And Broadcom CEO is a winner. So that's all I got to say about that.
All right, last piece of news, just on the NVIDIA front. And there's been some news of restrictions on their exports. These countries can get them, these can't. So what's going on with NVIDIA and why should we care with the portfolio?
Yeah, this is just background noise, but apparently someone from NVIDIA, I don't know if it was Jensen or someone else, had dinner at Mar-a-Lago, convinced them export controls on H20s were essentially bad, and it's kind of flipped the script. We'll see what details emerge from this, since we seem to be in kind of a trade war with China right now. But the only reason I wanted to bring this up was it shows how quickly some of these ideas can flip. And if there is some resolution, you might have a double-barreled chamber coming out of not only tariff resolution and lowered risk of recession, but you might have NVIDIA actually having access in a much more substantial way, and other companies, to China as a market. If China didn't have export controls, it would probably immediately provide a 20% boost to NVIDIA's EPS or so, something in that neighborhood. So, we'll see. It's just one of those news items that's so in the background right now because so much else is going on. But absent this craziness on the global stage, it would be potentially an incredible driver. So we'll be watching that one.
Great. All right. So let's finish things off with what people are probably most interested in. You said we have the portfolio fully allocated. We're watching those companies, but you've said many times you have other personal money that you have money coming in every week. What have you been buying, and how are you thinking about a few of these companies? Again, not necessarily recommendations for everyone. We're not saying this is what you should go out and do, but just wanted to hear what you've been doing and which companies you've been adding to. I know you alluded to a couple of them.
Yeah, definitely. I don't expect a single person watching the show to go, I'm putting 500,000 aside and copying everything. If you have mystery person who doesn't exist, like I said, I wish we had done a better job, specifically that purchase of Meta and Amazon has restricted us in how strategic we can be in the current time. But again, I don't think anyone's investing in a way where you can't use ideas right now. So I want to talk about a few of the ideas that I've purchased recently and reasons why. I went back and I added some synopsis to my portfolio. Talked about them before. They are going to be kind of levered towards semiconductor spend, but they are the company that designs the software, to make and chips. I think they're going to have a very compelling play around agents and being able to get basically better economics from their software. When we first talked about them in kind of the essential semiconductor stocks, I believe in episode number 1, I said, keep them as break glass in case of steep declines. We have a steep decline. I broke the glass and bought them. I added some Amazon. That's been being down quite a bit, but I love Amazon's potential in the coming years. They're leading hyperscaler. I think robotics is a coming place where we're going to see incredible gains. And I think no company is going to be able to see it impact its functions more than Amazon. So I will just continue adding to them. They're going to be punished in a couple ways because they'll have tariff exposure for their products to China. Consumers will pull back on spending. And also, don't forget that they have a very large advertising business, which I mentioned will be kind of cyclically impacted. I still think I will take whatever pain I need to in the interim for the long-term outcome from them, which I think is very good. Applied Optoelectronics, I bought just a tiny, tiny bit on a scale of 1 to 10 for risk. It's an 11. It is a tiny optics play. The guest we had on last week had talked about, but it's a company that actually does have some domestic production, not a lot, but it has some in an industry that otherwise doesn't have a lot of it. And, it's just, again, this company's trading for basically where it was in early 2024. But since then, they've announced a series of massive deals. I think they're engaged with 3 hyperscalers now. Their Amazon deal alone had purchase obligations that could be equal to 8 years worth of revenue. And all this news is now factored into nothing in its share price relative to early last year. So I'm just, am I going to make that a big position at this moment? No, but I'm going to add some. I purchased Google, Alphabet. We just talked about the reasons why. Mercado Libre. We haven't talked about this one in terms of AI, but it's a core holding of mine. I continue adding to it. On the software side, I added GitLab. I really like their opportunity moving forward with all software things. It's just a question of how expensive it is. So you've moved down from forward sales beyond 10 times to a more reasonable level. I'm going to take advantage of that and continue adding to it. Snowflake's another company we've talked about. And again, same exact issue. Expensive, getting cheaper. I'm going to add if economic uncertainty is not the main discussion in a year, this is going to be a successful purchase. Fabrinet, another pass by in the portfolio. I talked about why they've got a production advantage. In terms of these optical stocks, this is the least risky version of them. I really think Fabrinet across 5 years is going to be a winner with where AI is heading. It's going to be a substantial winner. So I'm going to withstand some pain. Just a couple more, David. I've been doing a lot of buying, I guess. Meta Platforms, added to them. I will continue adding to them in drips because they are down to about a P of 20. I think they have the greatest data in terms of first-party data to them and distribution advantage. I want to make that core holding. Taiwan Semiconductor added just a little bit too. And a stock now in the portfolio I'll mention. I add some Celestica. This is a company that they're manufacturing. They've got a lot of expertise with manufacturing and design services around racks that are going in data centers. They've won an absurd amount of contracts in the past year. And with them down dramatically, I want to add them to the portfolio despite their riskiness. So, David, hopefully, I know that is rapid fire, but showing, I would say I've used, a quarter of the capital I had available. And I will continue, I'm just going to continue dribbling it out. I'm not going to make any one big movement. I'm just going to continue dribbling out while we're at these levels. And I expect that there's a potential for more pain. And I also expect with high confidence levels then 3 or 4 years, when I look back at this moment, I'm as I did with the movements I did in COVID, I'm only going to be kicking myself for not going, more aggressive, right?
Yeah. Well, this is the game. This is why so many people love following investing and love following the stock market. You can have such big changes. It seems like forever ago, we were on this show a few months ago, and I think your exact quote was, I'm feeling a little uncomfortable just how bulled up everyone was and how much kind of enthusiasm was in the market. And fast forward today, it seems like we have run to the other side of the boat, and you're hard pressed to find a lot of enthusiasm in the market today.
If that was a 90 greed, right now is right now is a 3 fear. That's where we are in the opposite ends of the spectrum. So do with that information what you will. But I think there is a fear and greed meter, and those are the actual numbers right now. We are at like a 3, right?
I mean, I would believe it. But again, that's what this is what happens. Every time it feels like we're in the clear, there's something there. So it's hopefully we can provide some assurance that there are still businesses here. Don't panic, please. If you're selling now, might be you've missed the opportunity to sell. So hopefully,
by the way, I just looked up. There is a fear and greed meter. It was at 3 last week. We have moved up to 14. So there you go. That's where we're at.
So not so bad. Well, hopefully the show's been helpful, and we'll be back in 2 weeks. We'll see everyone then. People on this show may have interest in the stocks they talk about. This is not investment advice, so don't buy or sell based solely on what you hear.